While the global specialty chemical market remained subdued throughout the last fiscal year, Privi Specialty Chemicals reported an atypically strong FY26 performance. This is their current baseline, 2,582 crore rupees in revenue, supported by a resilient 25.76% EBITDA margin. On the right side of the screen is management's stated target for the next 3 to 4 years, doubling revenue to 5,000 crore while pushing EBITDA past the 1,000 crore mark. Doubling a manufacturing footprint often degrades capital efficiency and return on capital employed. To succeed, Privi must scale without allowing its operational margins to erode. Achieving this requires a structural expansion of their production logic, moving beyond volume increases to change how they process raw materials and value-added molecules. This plan is built on 3 pillars: the expansion of base capacity, a shift toward high-value R&D products, and the implementation of backward integration. Privi is currently integrating new biotech capabilities into its existing manufacturing platform, a move that requires precise coordination across all 3 pillars. To understand the viability of this scale-up, we have to look at how they protected their 22% top-line growth during FY26. This waterfall chart breaks down the growth, a 6.5% volume increase alongside 8% strategic pricing. This pricing power comes from their revenue structure. As the pie chart isolates, 70% of sales are export-heavy contracts rather than volatile stock markets. While contracts offer revenue stability, they also require a defensive strategy to manage the cost of raw materials. This pipeline flow shows their inventory buffer. They maintain 1 to 2 months of contracted raw materials, with another month in transit. When spot prices spike, the impact hits this buffer and flatlines before disrupting internal costs. This 3-month visibility allows Privi to maintain reliability across a catalog of 100 different aroma chemicals. This chart highlights the results of that discipline. Operational efficiencies and cost optimization allowed the company to maintain its EBITDA margins throughout the year. Protecting current cash flows through supply chain hedging is the foundation required to finance their multi-phase expansion. The first pillar of that expansion is a direct increase in manufacturing capacity. Phase 1 of the current capital expenditure program is on track for completion by June 2026. As the timeline marker shows, this phase will bring total installed capacity to 54,000 metric tons per annum. Once the third phase is complete in late 2028, Privi's total capacity reaches 72,000 metric tons. Alongside their internal capacity, Privi is utilizing a joint venture called Prigiv to drive additional volume. Their partner in this venture is Givaudan, providing a direct link to one of the world's largest aroma chemical consumers. In the 4th quarter of FY26, Prigiv achieved a significant financial milestone by reporting a standalone profit for the first time. This performance is supported by a new 50 crore investment, funded through a 51. Commercialization of 3 specific high-margin products, ethyl maltol, maltol, and cyclopentanone, is scheduled to begin in the 1st quarter of FY27. While advanced molecules generate more revenue, they often require expensive external precursors that can erode profitability. This leads to the second pillar of the strategy, backward integration to control the input supply. This supply chain flowchart shows their plan to produce furfural internally by the FY28 timeline. This integration locks in their supply of precursors at the exact same time they reach their 72,000-ton capacity ceiling. Management has confirmed a 2-year implementation window for this project, positioning it to support the final phase of their expansion. Moving downstream allows Privi to increase the value of each ton produced, while backward integration reduces the cost of the inputs required to produce them. The third pillar of the platform is a longer-term investment in biotech-driven biomass conversion. They have allocated 70 to 75 crore rupees to build a demonstration plant for this technology. The objective is to convert biological waste into chemical products and energy on a multi-ton per day scale. This is being managed as a distinct project, separate from their current specialty chemical expansions. This demonstration plant acts as a proof of concept for reducing reliance on traditional petrochemical and agricultural precursors by generating raw materials internally from waste. While the physical plants expand, Privi is also reorganizing its corporate structure. They are currently merging Privi Fine Sciences and Privi Biotechnologies directly into the parent company. This consolidation is designed to capture operational synergies by removing redundant administrative and operational layers. Final approval for this merger from the NCLT is expected during FY27. Privi is attempting to fund this multi-year expansion without taking on excessive financial risk. Their working capital cycle currently stands at 117 days, with a net debt-to-equity ratio of 0.62. This financial standing is what allows the company to pursue these capacity targets through internal accruals and managed debt. Maintaining these metrics is critical to funding the 72,000-ton capacity goal without significantly diluting shareholder value. Management has stated that they expect to maintain return ratios, including ROE and ROCE, in excess of 20% throughout this growth phase. By synchronizing capacity expansion with downstream R&D and internal supply chain integration, Privi built the operational infrastructure required to chase that 5,000 crore revenue target.